In this video, we're going to look at debt financing. And we're going to be able to compare debt financing versus equity financing. So let's just start with some brainstorming. At this point, I would encourage you to pause the video and think about what are the different ways that a corporation can finance long-term debt. Suppose a corporation wants to buy a vehicle, or perhaps there's some investment opportunity which is very large and requires several millions of dollars, and they don't exactly have the money at the time. How could a corporation get this money? How could they end up getting that asset or that investment going? Again, pause and think. So here's some methods for long-term debt financing. There's debt financing, which you can get a loan. There's a notes payable, or there's bonds. So let's just discuss the differences between these. A loan, you can go to a financial institution or possibly a person or some sort of company and say, hey, I'd like to borrow money. And with that loan, you end up getting the money and then they end up paying interest for it. It's not a bad way of doing it. Notes payable, same kind of concept, could just be through a company and you're continually paying money back. Generally speaking, with loans and notes payable, they are usually fixed to the person or company that you start that loan or notes payable with, and it's usually non-transferable. There are also some other differences that could come along with this, which is perhaps one could be a variable interest rate and the other one could be a fixed interest rate. Maybe they're attached to an asset, maybe they're not attached to an asset. And so there are different ways of financing things. Bonds are kind of like a loan that could be transferred to somebody else. So it's what we call a financial instrument. We end up getting a bond, we get money for it, and we still have to pay interest on it. But in the end, if the bank has bonds, they may be able to transfer it to somebody else. So it's kind of like a share, except it's debt. You buy debt and then you can sell it to somebody else and you're expecting to get the interest back. Obviously, if a company is doing poorly and they have a bond values also go up and down just like stocks. Then there's the other side, which is equity financing. This is where we issue shares. So in the next example, we're going to have a slight story and two options. Microsystems Incorporating is planning to finance the purchase of a building that costs $5 million and expects to earn $1.5 million by the end of the year. Option 1. Well, Microsystems can equity finance by issuing 200,000 shares at $25 per share. Option 2. Debt finance by issuing a $5 million bond at 6% interest. So you'll notice that both numbers come out to, what is it? I think they're both $5 million. Yep, they are. But they are completely different. One is equity, one is debt financing. Here's some other information which is really important because it matters. The income tax rate is 30%. There's 100,000 currently common shares that have been issued with a value of $2.5 million. So when we talk about this issuing of shares is not small. So let's just kind of go through the numbers, a side-by-side example of what's going to happen. So we already know right now for both of them that the income is going to be $1.5 million. That's no different. But what about the interest? In option 1, what do we have? We have equity finance. So there's no interest involved with option number 1. But on the other side, we've got 6% of $5 million, which will be $300,000. What's the income before taxes? Well, with equity financing, it's 1.5 million minus 0, which is going to be 1.5 million, and this will be 1.2 million. The income tax expense, it's 30%, so 450,000 here, and 30% of 1.2 million is 360,000. After taxes, what's the income? Well, we've got 1.05 million and 840,000 for option 2. So this is where it gets interesting. We're going to take a look at how the financing has affected the earnings per share and the return on equity. Right here, we've got common shares issued in the first one. Well, we issued 200,000 shares, which is actually a lot. It was a lot of shares that we issued. And in most cases, you're not going to find that you're going to finance out that much. I mean, if you're going to do that as equity financing, essentially you're making whoever it is owners in the corporation now majority stakeholders. And typically when large corporations do this, it's not going to be giving away 60% or more than majority control. But for the sake of comparing and showing drastic changes in earnings per share and equity, that's why we create these strange numbers. So shareholder equity is 8.55 million in option 1, and on the other side we've got it hasn't changed. It's still 3.34 million. So let's take a look at the earnings per share. We're going to take the amounts here and we're going to divide it by the shareholder equity. The number of common shares. So what we have in the first one is roughly going to be $3.5 per share, and with the debt financing we've got $8.4 per share. That's a pretty big difference. What's the return on equity? Well, the return on equity is going to be taking our earnings per share divided by the cost of the share, or the shareholder's equity portion. So what's it going to be? In this case, this is 12.28%, and on the other side of it, it's going to be 25.15%. So we start to see here that the return on equity is drastically different. So if you're a person who owns shares, you don't really like this option to finance using equity. In fact, you'd rather go off and you would rather have it financed by debt. So why not debt finance all the time? There's a good question. Well, financial institutions may not have the funds for large projects. So if we're talking about something like Apple making some sort of very large plan and it costs billions of dollars, then the banks may not have the money that can actually finance it. And by the way, you can also do partial financing one way, and you can finance it both ways and try and mitigate kind of what happens with the debt financing. Also, debt financing involves some more risk due to the obligations to repay its debts. So I talked a little bit about at the beginning about sometimes debts can be secured, and if you fail to pay your debt, suppose that debt is secured to a building or a car, then the person who you lent the money to can come and they end up selling it, and then they get the money, even if it's not necessarily beneficial for you at the time. So let's look at the pros of debt financing. Pro: debt financing. Shareholder control is not affected. The shares in the second example stayed at 100,000 from the start to the finish. Income tax is reduced because interest on the debt can be deducted. The earnings per share is usually higher, and the return on equity is usually higher also. And we got to see that in the example that we showed. Again, it's a very extreme example, but it really emphasizes what's going on in terms of the differences between debt financing and equity financing. Cons: the risk of inability to pay the debt can force sale of assets, whereas companies are not obligated to pay dividends or repay shareholders. So generally we don't want to do this. If we're talking about equity financing and we promise shareholders that we're going to pay them a specific dividend, we generally don't want to upset them. But it can happen that if we don't have the money, a corporation doesn't have to pay the dividends. It can lie. It can say, okay, well, we promised this, but sorry guys, we reevaluated and we're no longer paying this debt. Or sorry, the dividend. So here's something else to consider. Financial leverage is really important. What you can do with $10,000, maybe I can do something different with $10,000. So sometimes what we do is we have margin where we can borrow against some of the money that we have. So I could take $10,000 and turn it into more by borrowing against it. I know it's a weird concept, but if you are looking into investing, this is how you can use financial leveraging to increase your rate of return. But it's not risk-free. So what exactly is financial leverage? It's borrowing at one rate and investing at another rate. So let's just say it's beneficial when the rate of borrowing is less than the rate of investing. So here's an example. Getting a mortgage at 6% to invest in a property that will pay out 10%. Sounds great. You get a spread of 4%. 10 minus 6 is 4%. And if it's a large amount, that could be significant. Think about 4% on $100,000. That's an extra $4,000 a year extra. Now, of course, there's some tax implications that come along with that. And so you're not exactly getting exactly $4,000. There's going to be some income tax that comes along. I once knew a friend, a real estate agent who had a company as a partnership, and they invested in 37 properties at their peak. The financial crisis hit, and all of a sudden, those 37 properties, the tenants couldn't pay their rent. And so what happened, because he was financially leveraged out, he ended up having to sell pretty much more than half of the properties that they owned to try and save the business. And when they made the sale on those properties, it was not good. So that is the risk of financial leverage. Financial leverage also explains why banks exist. So it's when you deposit your money at the bank, it earns interest, while at the same time, banks will end up lending out that money at higher rates. Hence why mortgage rates are expressed as prime plus 1. So if the prime rate, borrowing rate, is set at the Bank of Canada increases, mortgage rates also increase as well. Banks continue to make profit on the difference between whatever this price, the rate is set by the bank, and what they actually give to you. Of course, they also have to cover their operational costs. Problem: personal debt in Canada is at an all-time high per capita, and an increase in interest rates could lead to people defaulting. That means failing to be able to pay. So this is something which has been kind of in the news for the last, I'd say, 8 to 10 years. And so I would encourage you to think about your own personal debt and finances. And at least on my end, I'm a very risk-averse person. I try not to have debt as much as possible, but at the same time, if you see an opportunity and it seems pretty solid, you should go for it and try and use debt financing to fund it. That's it for this lesson. I hope you've enjoyed. If you have any questions, reach out to me on Google Classroom or by email. Bye for now.